People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. They're not discouraged, they just think it's a gamble.
Once again, we are learning from Peter Lynch, one of the greatest investors of all time, and my favorite comedian of all time. For those of you who don't know Lynch, he was a fund manager at Fidelity Investments. During his 13 years as manager, Lynch increased the fund size from $18 million to more than $14 billion, making it the largest mutual fund in the world at that time. Even though Lynch retired in 1990 at the age of 46, he has left a lot of great advice for us retail investors on how we can invest successfully. Today, we are listening to one of those knowledge-packed interviews. Hope you guys enjoy.
People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. They're not discouraged, they just think it's a gamble. So therefore they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your philosophy is simple, and I'm remembering this from the previous book. I think we're now talking about the previous book.
Correct.
Your philosophy was, if you find something that you identify with. I remember there was a story of your wife and her hose. Your wife kept saying, these are legs,
you got it.
The legs and panties. Your wife said, these are the greatest things I've ever seen. And when your wife said that, you knew that this was a product that was better. You used to stay at La Quinta Motel, and the service was better, whatever was better.
The price was good.
And the price was good too. And you said, this is a place that I can determine. I, Peter Lynch, can tell that this is a good product, right? And if these people are making a good product, then their earnings are going to go up, therefore the stock's going to go up. And that's the kind of decision-making process you ought to go through. Do I have it?
You've got it exactly right. Well, I don't think people understand there's 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company, the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company. If we're in a recession, people are not going to spend as much money on going to the movies or whatever they do. And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve. He cannot predict interest rates. He'd be the first to tell you.
He can influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
Here's a quote from you. I own Dunkin' Donuts. When you own Dunkin' Donuts, you don't have to worry about Korean imports. You don't have to worry about M2 or M3. These are money supply figures, aren't they? And what's happening to the money supply? This is the way you make money. If you don't understand what the company does, you should not be in it. If you could predict the stock market, you could predict the economy, you could predict interest rates. If you go buy the wrong stocks, you're going to lose half your money anyway.
I'm saying people have natural advantages. Let's say what you do for a living is you're involved in the restaurant industry. You supply paper products. You supply kitchen equipment. You help build restaurants. You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
No.
That's all you had to do was follow the restaurant industry. People are in industries. They're in the publishing industry. They're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need a lifetime? Instead of people that are in the restaurant industry, they're buying biotechnology stocks. The people in the chemical industry
nothing about
nothing
biotech.
about it. The people in the chemical industry are buying oil stocks. It's absolutely absurd.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
yes,
don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
what do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what what all these things are with auto back planes and mega flops? Who knows what all these
So buy what you know.
Buy in your industry, buy what you know, buy local companies.
Yeah, so suppose you don't have an industry. I mean, you don't really...
You buy local companies, companies in your own industry. 10 years after Walmart went public, 10 years after
Walmart.
10 years after it went public, it's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. 50 times.
If you bought it 10 years
after it was public already.
Yeah.
It already gone up 5-fold. So you could have made 250-fold. But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains. And you checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's in only 10% of the country. They're not even saturated there. Why can't they go to the rest of the country? He claims that we're going to do more investing and less spending.
Right.
And that statement you can't argue with.
Less consumption, more saving.
You absolutely have to invest more in education. You have to invest more in companies. You have to invest less in just spending money. I mean, today people are encouraged to spend. You spend money. Let's say you put an addition on your house. Right. You spend money on that. You can get a tax deduction because the interest on it is tax deductible. Mm-hmm. If you take your money and put it in the bank, you're taxed at a very high rate. They have this incredibly unfair term. It's called unearned income. Every time I do on the income taxes, and I fill out the number for what you made, the money you put in the bank, and it's called unearned income. It's an insulting term. But anyway, if you buy a stock and you make money on it, you pay a 28% tax on it.
Yeah.
Guess what the capital gains rate is in Japan?
Capital gains rate in Japan is 10%.
Zero.
Right.
I mean, we're not encouraging people to save. We're not encouraging people to invest.
So
we're encouraging people to spend.
You're in favor of the elimination of the capital gains tax that Bush proposed?
Reducing it or eliminating it. And I'm glad that Clinton didn't raise it. I mean, he raised other taxes. This fairness thing, I understand.
And what about this tax the rich business? You buy that?
I think fairness, it's a debate what's fair. I certainly think raising taxes is appropriate if it's at the same time you cut the spending. It's a lot easier to raise taxes than cut spending. If we can cut spending and get government's share of the gross national product reduced, it'll be fair.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny, in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so it's ones that go up tenfold. I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold it. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying it's a cyclical company and they're doing poorly, and they're doing awful, you wait till things are getting better, and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. Yeah. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Yeah. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you could lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Does your own confidence ever get shaken?
Every day I think the market's going to go up. You know, I keep calling a lot in my company, so I keep calling the company.